All right, everybody, welcome to this Tax Foresight webinar. My name is Ben Allery. I am your host. I'm the co-founder and CEO of a company called Blue Jay Legal, which is based here in Toronto, and really excited to talk to you about predicting judicial decision-making with machine learning. Today, we're going to be talking about central management and control. So this is a very common question that arises in international taxation. The goal today is to walk through an example, actually not directly on point with considering where a corporation is centrally managed and controlled from. Instead, we're going to look at the case of a trust. And so we're going to look at a really famous case from a few years ago called Guerin Trust, sometimes also referred to as the Funny settlement. But this is a case involving the determination of where a trust's business was centrally managed and controlled from. This went all the way up to the Supreme Court of Canada. So we're going to focus on that. But overall, the idea here is to give you a sense of how you can use machine learning to get insight into how the courts are likely to exercise their discretion. So what we do at Blue Jay Legal is figure out just how the courts have exercised discretion in the past in these different areas where there are discretionary calls to be made, and we train machine learning algorithms on tons of cases, all the cases in that area. And then what we do is we provide a means of essentially getting insight into what the courts have done before. So that's the plan for today. We're going to look at this question of central management and control as it applies to corporations and trusts, and how you can use Tax Foresight, which is a product that we offer alongside Thomson Reuters here in Canada, to figure out how courts are likely to exercise this discretion. But before we jump into central management and control, do a little bit of context setting here and explain where this technology fits in the general arc of what's happening in machine learning and artificial intelligence and the law. Because I think it's really important to get our bearings here about what's going on, what's possible, and where we're at. So the way that we like to think about the emergence of new legal research technology is to start with the book. And of course, there's a fascinating history about what the book has done to legal systems. And I'm looking forward to doing a TED Talk tomorrow on precisely this issue, looking at books as a form of legal technology and how books relate to computers and the future of law. But if you just take as granted that the legal system really began with books and the printing press and Gutenberg, you can imagine that right up until the 1970s, not really a whole lot changed, right? So we had a lot of legal research done through books, case reporters collecting information, secondary literature written by law professors, observers of the tax system, and others contributing to our understanding of legal system. In the 1970s, things began to change, and what we saw was a transition at the first stage of computing and legal technology towards taking that information that had previously appeared in books and moving it into digital format. So getting things online, originally on discs, on CD-ROMs, on DVDs, just on hard drives locally installed, even floppy disks early on, really serious limitations of how much data you could access early on in the 1970s. But as time went on, we kind of reached kind of peak book in the late 90s, I would argue. And we started to see online legal research really take off. And so that's when digital really started to move into the second phase, and networked machines accessing huge repositories of centralized information. Things like Westlaw really started to emerge and gain significant traction. And lots of firms, accounting firms, law firms started to reduce their hard copy collections of these materials because the online sources are just so great and so useful. Keyword search, hyperlink, that sort of thing. Now, in the last few years, we're beginning to see the emergence of this next wave of the application of computing to the law. And this involves computational law. And what it really means is that we're exploiting the fact that we've got all these materials in digital format. We've got exponentially increasing computing power following Moore's law. And we've got algorithms that can sort through all this digital information and make sense out of it in ways that were previously not possible. So this is really, really an exciting time to be a lawyer, to be an accountant, to be looking at the provision of professional services in this area, because suddenly new tools are coming onto the market and they're making possible stuff that just was not possible before, because nobody could read all of the cases in one of these areas and keep straight all of the results. And so there's been traditionally a lot of shooting from the hip, kind of heuristically motivated reasoning without as much insight as is possible now into how that discretion is going to be exercised in court. So that's what we're going to be focusing on today. How is this actually playing out in real time, and what tools are available? What can you do with machine learning in the law? And so there are lots of different use cases of this kind of technology. The way we think about it is that there are at least three great things that using this computational methodology to guiding legal advice makes possible that just wasn't possible before in the same way. So, for example, one thing is just leveling up the quality of the legal advice or the tax advice you're able to give to a client by taking into account all of the information available on a particular topic. So being able to leverage all of the judgments in a particular issue with respect to a particular legal issue that arises in tax law has never really been possible before, unless you had a very, very niche issue where there might only be one case or potentially no cases. Then everyone's in the same boat, because you can just read the statute, and that's the beginning and end of the authoritative legal sources to look to for that answer. Anywhere you have a significant discretionary call and there is a body of case law that's been developed, it's extremely costly to look at all of those applicable precedents and take them into account in guiding your advice. And so this is something that's now possible using tax foresight. The second thing that tax accountants, tax lawyers have been doing for a very long time, but in a less robust way, I would argue, than using tax foresight as a starting point, is a way to validate instincts. So any significant tax practice is going to have more than one person providing advice, and there are huge returns to having multiple people to bounce ideas back and forth around, and to compare your instincts, to get feedback from others in the tax group before you provide an answer to the client, or even just running a draft opinion past somebody. That's now possible it's now possible to use tax foresight to inform that original instinct, or to validate an instinct, run it past the algorithm and run a bunch of different scenarios and get a sense of what the lay of the land is with respect to a particular legal issue. So this is something that's very new, that's only available using these kinds of computational tools. So pretty exciting development now for the many firms that are already using tax foresight. We get reports that this is really, really important to them. Something that's very important for clients is quantifying the risk for clients. So as you know, if you're in practice, different clients have different risk appetites. So some clients are very, very aggressive. They want to take the most aggressive position possible with respect to their tax liability. They just don't want to be in the position of paying taxes that are not legally owed. Other clients are more circumspect, and they'd rather play it safe. They don't want to have any kind of reputational risk that they're taking on and taking an overly aggressive tax position. And so lots of clients really start off conversing with a tax professional. Well, how do we play this one safe? Or is this the best we can do? Can we be more aggressive? Are there things we can do? And if the lawyer or accountant says, well, there are these things we can try, the natural follow-on question is, well, just how risky is that? What are the chances that this goes sideways for us? What's the exposure if it does? And a lot of times, professionals are in the position of kind of guessing, right? Well, I think it's a should, or I think it's a will, or I think it's a may kind of opinion, and it's very imprecise. It's based on those professional instincts that have been honed over a period of time. Using tax foresight allows you to give substance, some kind of foundation to those beliefs, and to use tax foresight and all the accumulated case law to inform one's priors about just how strong an opinion could be given to that client, because that's what clients want. They want to know just what is the exposure, how likely is that exposure to materialize, how confident can I be that this is actually going to go through. So that's a really important dimension to all of this. Okay, so what does the software actually do? What does tax foresight do? What does employment foresight do? Well, the software really makes it easy to understand and strengthen your position with respect to common issues that arise all the time. With respect to tax foresight, it's in tax law. With respect to other products, and it's in other areas of the law. And we've got different kinds of functionality. So some of which will be more familiar to those who are really familiar with traditional research methods. So our search function uses essentially common factors, common features of the cases, and allows you to filter through the case law and find those cases that match on those particular aspects of the case that you're most curious about learning and exploring about, and identify those cases that are most similar to the case that you have in mind. Case analytics is a suite of visualization functions that allow you to really visualize how the case law breaks down and what the results are if you turn on or off different kinds of feature flags in your search. So it's a way to very, very rapidly get a sense of, okay, so what are the courts doing with respect to this issue, if this is present or if it's absent, and to basically put a whole bunch of those factors together to get a sense of what are the judges actually doing when they decide these cases. And you can limit it to a certain period of time or expand it out to include all of the case law. You're in the driver's seat. You can limit it to certain courts, trial courts only, or appellate courts only, or mix and match whatever courts you want. So the search function's pretty straightforward, very much part of the digital revolution in research. So we looked at analog to digital to computational. The search functions are really part of that digital stage in legal research. The answer parts are more in the computational stage. So the foremost function that uses machine learning are the classifiers, and we're going to run through the central management and control classifier in a little bit. The classifiers really use machine learning to generate predictions about what the courts would do in a new situation. So how would courts exercise their discretion when faced with one of these questions, and they go one way or the other way in any particular situation. So lots of different issues we address in tax foresight using the case finders and the classifiers and the navigators. You'll see at the bottom of the screen, we've got reference to the general anti-avoidance rule, residency, carrying on business, worker classification, so as a worker, an independent contractor, or an employee, taxable benefits, real estate characterization, so our gains from real estate on income account, as they would be if you were in the business of developing land as a land developer, or should they actually be treated as capital gains, which it would be if you're principally engaged in the investment in real estate. Okay, so a whole bunch of different issues, and there are 25 different issues in tax foresight at the moment. So this is just scratching the surface, and we're going to be focusing on central management and control today. What's really striking about tax foresight is just how accurate it can be. So when you look at all of the case law and inform a prediction based on all of the case law, it allows you to make a really confident prediction about what a court would do in a novel situation. And so what we're finding is tax foresight, as new cases come out of the courts, we're predicting about 90% of those cases correctly based on the predictions of the machine learning algorithms that tax foresight uses. And so this is really, really exciting. There's no way the machine learning algorithms have been exposed to these future judgments. So there's no way that they could have foreseen explicitly or kind of been tipped off to what the courts are going to do in the future. But we are predicting about 90% of the new cases as they come down on average. Sometimes for some of the classifiers it's a little bit higher, for some of them it's a little bit lower, but 90% is about where we're at in terms of the accuracy. Now, in our experience, real lawyers, real tax professionals have an accuracy rate of somewhere in the the mid 60s. So roughly 68%, mid to high 60s, 68% of predictions of real tax professionals in similar sorts of situations are correct. And so what that means is tax foresight is making about 1/3 of the errors of your average tax professional. There are some tax professionals whose instincts are extremely well calibrated in some of these areas, and they will outperform almost everybody else in these areas, and their accuracy will rival that of tax foresight. But most tax professionals just have not dealt with dozens and dozens of cases in these areas. So using tax foresight allows you to level up to the expertise of someone who is extremely well versed in the case law in one of these areas very, very rapidly. And so just an entry level tax professional can give advice that's informed by this kind of accurate prediction, as well as someone who's been a seasoned professional for decades. So it's really exciting time to be entering the tax profession. We've got widespread adoption of our tools. Some really amazing firms have joined us, have agreed for us to exhibit their logo and identify them as leaders, thought leaders in the area and adopting new technology. These are some of them. There's a longer list on our website, and then there's a long list of firms that haven't said, yes, please go ahead and use our logo. So it's happening, it's out there. Right now, as we speak, people are using this functionality to inform the tax advice that they're giving. Okay, so now let's get into the meat and potatoes of this presentation. So what's happening in the context of this classifier is we're examining this question about central management and control. And so where is the central management and control of a corporation in Canada such that the corporation will be considered to be resident in Canada for tax purposes? So for those of you who are not particularly familiar with where and why this question comes up, I'll just give you a very quick sense of how this comes up. So in the Income Tax Act, we've got the basic presumption that residents in Canada are taxable on their worldwide income. We've got the presumption that those taxpayers who are not resident in Canada are taxed in Canada typically only on sources of income that are sourced in Canada. So if you're a non-resident, then you're taxed presumptively just on your Canadian source income. If you are a Canadian resident, the presumption is you're taxed on your worldwide income. And so this can give rise to conflicts because a lot of other countries have similar provision for their residents to be taxed on a worldwide basis. And so if Canada is imposing tax on a source basis on non-residents, that non-resident is probably resident in some other jurisdiction, and that other jurisdiction is going to want to tax them on all of their worldwide income, including their Canadian source income. So we've got a conflict there between the Canadian tax on the Canadian income and the worldwide tax that's going to be imposed on that non-resident taxpayer. For that reason, for that general resident source conflict, we have a long list of double tax treaties with other jurisdictions. I think at last count, we had well over 100 of these bilateral tax treaties, either tax treaties or tax information exchange agreements with other countries. Very, very common for Canada to enter into these bilateral tax treaties that essentially carve up the tax liability. In the Canadian Income Tax Act, there are a number of provisions that provide for a deemed residency treatment for corporations. So as an example, if a company is incorporated in Canada, it's usually deemed to be resident in Canada for tax purposes. There's certain time strictures that affect those deeming rules, but typically if a company is incorporated in Canada, it's going to be deemed to be resident in Canada for tax purposes. Where it gets really interesting is where you have a company that is not incorporated in Canada, but carries on a lot of its activities in Canada, should it be deemed to be resident in Canada. And so this is kind of similar to individuals. So an individual might not be a citizen of Canada, So it might not be the equivalent of being incorporated in Canada, but an individual might be a citizen of a different country, but could very well be a resident for tax purposes of Canada. And that's often based on where they make their living, where do they spend most of their time, where do they have their social, economic, and other ties, cultural ties. And so when we're figuring out the residency of individuals, we really look at where individuals spend a lot of their time, make their key decisions, live their life, engage in their work, engage in their friendships, engage in their social connections, where their family live, those sorts of questions. And there's a very famous case from 1906, decided by the House of Lords, the UK House of Lords, called De Beers, where the question was, okay, so we've got these tests for residency of individuals. How should we be figuring out the residency of corporations? A corporation is a legal fiction. It's created pursuant to Corporations Acts. And how do we think about a corporation? It's a very abstract thing. How should we think about determining the residency of a corporation? If we're not going to rely on some kind of deeming rule that says incorporation leads to residency, if we're not going to rely on that, we're just going to look at, okay, so how do we determine where the company is going to be resident for tax purposes? The UK House of Lords said, well, what we should do is analogize to an individual and ask, where does the company basically live and keep house and do its work? Where are the key decisions relating to the company actually made? How is it governed? What's going on in the broader context in the business or other life of the company? And so in 1906, the House of Lords said, okay, in this context, in the corporate context, what we're going to do is draw an analogy to how an individual is determined to be resident, in that case in the UK, for tax purposes, for the corporation. So we're going to look at where the board of directors meets, where they make decisions, where the key business actors are, where the business is actually carried on, and all of those sorts of things. Very, very interesting that the House of Lords drew an analogy to individuals in figuring out corporate residency. And that's what this classifier tends to focus on. It's like, okay, so on the assumption that you have a corporation, how do we figure out where the corporation is being centrally managed and controlled from? Where's its source of central management and control? That's going to tell us on a common law basis where that company is resident for tax purposes. It may also be resident in Canada if it's incorporated in Canada for other reasons because of these deeming rules, but we're focusing on this common law test. Where is it spending its time? Where is it carrying on its activities for the purposes of this discretionary, oh yes, this company is resident in Canada sort of test? Okay, so that's the background about this classifier. It's basically applying the test first articulated in De Beers and addressed many times since in the context of figuring out where companies are being centrally managed and controlled. Now, what's distinctive about the example that we're going to talk about, and it bears a little bit of further explanation, is that we're going to be looking at the residency of a trust here. And so a trust is somewhat different from a corporation. A trust is a different kind of entity altogether from a corporation. It's very common in tax planning, lots of different really valid uses for trusts in the tax planning context. And what a trust is it's a way of organizing the affairs relating to certain property. And so when you have a trust, you need to know about what is it that the trust owns, what is the trust property. There's somebody called the trustee in a trust. The trustee essentially acts as the board of directors or as the executives of a company would act, and they have a fiduciary duty towards the beneficiaries of the trust. And so the beneficiaries of the trust are those who are entitled to that property that's being held by the trust, governed by the trustees for the benefit of the beneficiaries. In the corporate context, you would have a board of directors elected by the shareholders. The board of directors and the executives that they appoint would be making the decisions on behalf of the shareholders and for the other stakeholders in the company. So a related kind of entity, but we're going to just show how interesting the parallel is between trusts and corporations when looking at this question of central management and control, because what the Supreme Court of Canada did in the Guerin Trust case in 2012 was essentially what the UK House of Lords did in the De Beers consolidated case back in 1906. In 1906, the UK House of Lords said corporations are like individuals. We just have to see where the corporation is actually kind of keeping house and engaging in its affairs. In 2012, the Supreme Court of Canada said, okay, we can figure out the residency of a trust by analogy to a corporation. And so we just need to see where the trust's key decisions are being made, where it's actually being governed, how that trustee is operating. So it's not just about where's that trustee resident, it's where is the effective control over the way that the trust is dealing with that trust property, where are those directions coming from? And so that's what we're gonna look to here. Okay, so we're gonna jump into a demo momentarily. I'm gonna step you through this and show you how you can use machine learning in a user-friendly way to get insight into how the courts would exercise their discretion. Just some very quick background, just so that this isn't totally in the abstract, about the Guerin Family Trust case. So this was a Supreme Court of Canada decision, as I mentioned, back in 2012. And it involves a potentially huge tax liability here in Canada. So there was a reorganization. It was kind of similar to a typical sort of freeze situation where new common shares of this holding company, PMPL, were issued for nominal consideration to the Guerin Family Trust. So it involved freezing in certain shares, exchanging shares for other shares. And what happened was the Guerin Family Trust ended up with a bunch of shares in PMPL. This trust, so the trust property are these shares of PMPL, and the trust had a corporate trustee. So the corporate trustee, St. Michael Trust Corporation, that was resident in Barbados. So this is a Barbados resident company, and Canada has a tax treaty with Barbados. So this is important. The trust is essentially created by an individual who is resident in a Caribbean jurisdiction. So the shares of PMPL were sold at arm's length, and the trust disposed of its shares in PMPL in the course of that transaction. So the Minister of National Revenue assessed the trust on the basis that this trust, the Guerin Family Trust, was resident in Canada. This was a big problem for the beneficiaries of the trust. Why was it a big problem for the beneficiaries of the trust? Well, because the trust realized more than $450 million worth of capital gains on the sale of the shares in PMPL. And so what that means is if the trust was resident in Canada, then those capital gains would be taxed in Canada, because a trust that's resident in Canada is taxable on its worldwide income and cannot claim exemption to tax in Canada based on the provisions of the Canada-Barbados Tax Treaty. So according to the terms of the Canada-Barbados Tax Treaty, as they applied to this transaction, if the trust, the Guerin Family Trust, had been resident in Barbados, then it was agreed that the gain on those shares would have been exempt from Canadian tax because it would have been taxable in Barbados. And of course, the rate of tax payable on those capital gains in Barbados was much lower than the rate of tax payable in Canada on those capital gains. Okay, so this went to the Tax Court of Canada. The trial judge at the tax court found that the trust was resident in Canada, and so the exemption in the tax treaty between Canada and Barbados was inapplicable. The trial judge held that the test for determining the residence of trusts is essentially the same as the common law test for the residence of corporations, namely, where is the central management and control of the trust property exercised? The trust appealed the Canadian residency finding up to the Supreme Court of Canada. So this is essentially the setup for this case. And I chose this example because it's really interesting. We can work through the central management and control classifier. You'll see that the questions are posed in the context of a corporation, but we can reason by analogy to figure out trust, how a trust might be treated, because the courts have said, look, the test for trust is basically the same as the test for corporations. Okay, so I'm going to jump into tax foresight now, and we're going to see how this plays out. Okay, so I'm just going to log in. This is exactly what our subscribers see when they log into tax foresight. So here I'm going to do a quick find for central management and control. Got it here. I'm going to click on the classifier. Okay, so you'll see that the software was just last updated today. And there's just a note here on corporate residency and deeming rules. Let's proceed on the basis that none of these deeming rules apply, not least because we're dealing with a trust. So there might be trust deeming rules that we'd want to attend to as well. Notably, check this out, less than 1% of the users who use this classifier disagree with the results. So we're confident that this classifier is producing sensible results. In out of sample testing, we're getting 90% accuracy on average. When users are using it, the results seem really intuitive. Okay, so I'm going to click next. Okay, so we're going to launch into this. What you see here is that it's going to ask a bunch of questions about the situation facing our taxpayer here. And here it's a trust. So any reference to corporations here, we're going to translate into the trust context. So where was the trust established, or if the trust has been continued, where is it last continued? So here we're going to say that this was a trust that was established in another country. It wasn't established in Canada. So this is essentially one of those threshold questions where if it was incorporated in Canada, or if the trust was created in Canada, there's a strong presumption that it's going to be resident in Canada, either because of a deeming rule or because it's just a strong presumption. Okay, what's the business or industry of the corporation? Well, here it's a trust holding corporate shares. Is the corporation registered as an extra provincial corporation in Canada or licensed to do business in any way in Canada? No, I'm going to say no. Select all of the following that apply. And if at any point I have any questions about how to answer these questions, I can just hover over this tooltip and it'll give us some more information about how to answer these questions. Okay, so I'm going to select all of the following here. I'm going to say that the trust head office is not located in Canada. Does it have a bank or trust account located in Canada? No. Has it previously filed a corporate tax return in Canada or a trust tax return? No. Let's see, is it some of the corporations, the trust books and other records? No. I would say that the majority of the trust accounting, legal, and tax management representatives reside in Canada. That's true. And a significant portion of the trust revenue generating activities is conducted in Canada. So that's true. So the background here is that the trust is holding a whole bunch of property. The shares in PMPL. PMPL is actually a company that indirectly holds a bunch of Canadian business assets. So the underlying business activities are actually happening in Canada. Okay, I'm going to click next here. Okay, so this gets into where the discretion is exercised by the decision makers here with respect to the trust. And so all the references here to the board of directors should, I think, in your mind, be recast as by the trustees. So the trustees really standing in for the board of directors here, and then the other decision makers are really the beneficiaries. So they're the ones who hold the significant economic stake in the shares. So question 2.1 asks us if there are decisions regarding the acquisition or disposal of substantial assets are made, who usually makes them? Well, that's going to be the beneficiaries of the trust who are in Canada. If decisions regarding significant items of capital expenditure are made, who usually makes them? The other decision maker. What we're going to see is there's going to be a lot of these other decision maker answers here, because this corporate trustee in Barbados is really kind of just taking instructions from the beneficiaries of the trust who are all resident in Canada. And so it's the Canadian resident beneficiaries who are basically giving the trustee instructions. So the trustee is just this company, this trust company based in Barbados, and it's an order taker. So the orders are coming from the beneficiaries. The beneficiaries are telling this trustee what to do. And so kind of by definition, they're the ones who, these other decision makers who are making all the decisions. So same thing with the approval of budgets, issues about what to do with respect to making distributions, any kind of operational, financial, or personnel policy, regarding the engagement or dismissal of senior personnel, other decision, all of these things are going to be other decision maker. In this case, the major reorganization, other decision maker, professional advisors, all of these things are other decision maker, because the shots really are being called by the Canadian resident beneficiaries. So one thing here, just as a side note, is Guerin Trust is a very, very important case, and the reason it went all the way up to the Supreme Court of Canada is there was a lot of uncertainty about whether trusts should be considered to be resident on the basis of the residency of the trustee. Lots of people thought that it was just a nice bright line rule. Wherever the trustee was resident, that would be where the trust would be found to be resident for tax purposes. And so you might be wondering, why did they think that this would work? Well, the Supreme Court of Canada decision did a couple things. One is it really said, no, you have to analogize to the corporate common law test for determining residency. That was a big surprise to a lot of folks in tax advisory. And then the other thing is, in these circumstances, on these facts, it actually became pretty clear that most of the shots were being called by the beneficiaries out of Ontario. So, okay, and that's based on factual findings from the Tax Court of Canada. Okay, what about the directors here? Again, this should be thought of as the trustee. Does the board of directors regularly receive, or does the trustee regularly receive and consider relevant information before making key decisions? No, I mean, they really just are given their orders, right? So the trustee is given orders by the beneficiary, so they don't really receive and consider the relevant information. They just go ahead and make the decisions consistent with what they're instructed to do by the beneficiaries. Is the board of directors generally able to explain why key decisions were made? No, they're just following those orders. Are there any restrictions or limitations on the powers, duties, or responsibilities of the trustee to manage the business and affairs of the corporation? I would say yes, for sure. So here, yeah, so they're hemmed in a number of ways. So it's not as if this corporate trustee could just say, okay, we're gonna new change of course, new beneficiaries, or we're just gonna favor one beneficiary. It's, as a practical matter, they're very much hemmed in. Okay, now with respect to these other decision makers, so we're now going to confront some questions about who these other decision makers are, because it's going to be an important part of the analysis. How do we actually figure out whether this particular trust should be deemed to be a common law resident in Canada? Which of the following applies to the other decision makers? They do regularly make key decisions without consulting the trustee, that's for sure. They do regularly make key decisions without the supervision of the trustee, that's for sure. Like they really are in the driver's seat here. They're making these decisions. The trustee is a nominee who's going to fulfill their wishes. They do regularly communicate decisions to third parties without consulting with the trustee. And they do regularly communicate decisions to third parties before the trustees had finalized the decision, because it is really a rubber stamp by the trustee in these circumstances. Okay, is there an agreement with the trust whereby the other decision makers, so the beneficiaries, agree to make decisions in consultation with or under the supervision of the trustee? No. Are the beneficiaries majority shareholders who control more than 50% of the trust's governance rights? So this is a little bit tricky. So I'm going to say no here. But this is a little bit tricky to analyze in this trust context. And so, but my intuition is telling me no, there are a number of different individuals who were involved as other decision makers here as beneficiaries, and so I don't think any one of them actually had a controlling stake in that way. Okay, 4.4. Are there any shareholder agreements, formal or otherwise, by which a voting majority of the shareholders decide to vote the same way as the other decision maker? No, not that I'm aware of. Okay, 4.5. If the beneficiaries are a subset of the trustees, does it regularly receive additional access to information or consulted beyond the main board of directors? So the trustee, I'd say not applicable. Okay, where are the trustees' meetings regularly held? Well, here, this is just the trustee meeting, and so that would be in Barbados. Where did the majority of the trustees reside? Well, that's other country. Are there any trustees resident in Canada? Here the answer is no. Where do the other decision makers reside? Yes, this is Canada, so these are the beneficiaries. And where are the key decisions of the other decision makers made? That's also in Canada. So these are the beneficiaries, all of whom are resident in Canada. Okay, so now we're at the end. The system's collected a whole bunch of information around the trust, what kind of key decisions are made and who makes them, stuff about the trustee, so tell us more about the trustee by analogy to the directors here. Who are the other decision makers? So these are really the beneficiaries of the trust. Who are they? And then some questions about where they're actually located. So both the trustee, here we call them directors, and also the other decision makers. Okay, so now that we're at the end, we can click compute. Play along with me here. In your own mind, come up with your prediction of where you think this trust will be found to be centrally managed and controlled from. And if you're able to, commit to a certain percentage of confidence that you have. So if you're watching this for CPD credit and you happen to be with a buddy, make a prediction, put your reputation on the line, make a commitment here, pick a direction. Is it centrally managed and controlled in Canada or not? And once you've done that, commit to a percentage confidence that you have in your answer. If you're alone, you're not really alone, I'm here with you. If you're alone, jot down your answer, and we'll see how you do. So I'm going to click compute, and the system's going to compare these facts to all the existing cases. And what we find is that the central management and control is likely to be in Canada. So 83%, that's roughly 5 out of 6 times if this case were to go to court. Based on past practice, the prediction is that a court would say that this particular trust is resident in Canada for tax purposes. So what we see on the results screen here is this overall result. We see the confidence, 83% in Canada. The cool thing here is that immediately we're confronted with the possibility of running this again with different variations of the facts. So what if the corporation had been incorporated or last continued in Canada? So what if the trust had been have been founded in Canada, we can just click find out. You know, it's very likely that about just a little bit marginally more likely to be in Canada. It's probably an underestimate on that click through, but that's how much certainty the algorithm has. What if the other decision makers reside in another country? So what if they're not actually in Canada? What if the beneficiaries are somewhere else? What does that do to the result? So it actually flips it. So it is really important that the beneficiaries are in Canada. In addition to a lot of the underlying business assets being in Canada, it's really important that those folks making those calls are resident in Canada. So I've clicked that back. So we're back to kind of the stock vanilla scenario that we started with. I'm going to show you some other things about this result screen. So we've got here the system generating an explanation about why the system's making this prediction about the outcome. So it kind of talks about the common law test for companies here, looks to where the company's real business is carried on, talks about the importance of where the board of directors meet and hold their meetings, looks to where the other decision makers are. Given that other decision makers are making a lot of key decisions, where are these people actually based? And again, you got to reconceptualize this as being in the trust context for this explanation to hold up. And then we'll look to similar cases. Okay, so Tax Foresight says, oh, you've got a very, very similar case to look at, and it's called Guerin Family Trust. And so it's suggesting that there are a ton of similarities between Guerin Family Trust and the facts as we've entered them into the system here. And it's saying, look, the underlying corporate activity is very similar. The fact that it's incorporated, the place of its incorporation or establishment is similar. The role of the other decision makers, so here the beneficiaries is very similar, the residence of the directors, and so on and so forth. So very, very similar. Nothing's actually dissimilar. So here, Waterloo Pastoral is a little bit different. It's a very old case, 1946, and it went in another direction. So if I were counsel for the Crown, I'd really be looking at Guerin Family Trust here and saying, hey, look, this is really, really a very similar case. If I wanted to find all of the cases that were as similar as possible to Guerin, I would be looking to say all those that found in Canada. If I was counsel for the taxpayer here, I'd be looking at the ones that were not resident in Canada. So I'd be changing that to not in Canada. Now we can just look at all the results. These are the leading cases. So these referred cases here are the ones that are most similar, or the most referenced cases. So these are kind of the leading authorities that the courts look to and cite to. And here's the De Beers case that I mentioned earlier, the 1906 decision of the House of Lords, very, very famous decision in this area, where it was decided that the Canadian, or the corporation is going to be resident by analogy to an individual to the extent possible. So really, really important. One of the things that a lot of our users do is they download reports. So if I click download report, what we'll get is a PDF version of this result screen. And so what it does is it replicates a lot of the stuff that you see on the result screen, gives us the overall result, 83% likely to be in Canada, provides the same explanation of the result, outlines the similar cases, provides links to the similar cases that will open up in TaxNet Pro, provides a link to the leading references also with links to TaxNet Pro, gives a complete reproduction of all the questions and all the specific answers that we gave to those questions. And what our clients are doing, what our customers are doing with these reports is they are often filing them with tax return. So if you're assisting with somebody's tax return, you need to take a certain filing position, then what you'll do is you'll download and file one of these reports along with the rest of the customers, the client's information. So just in case if there's ever any kind of disagreement about the position that you take on that particular aspect with the CRA, or ultimately potentially with the Department of Justice sometime later, you can pull out that report and say, well, as of, in this case, July 31st, 2018, the best prediction based on all of the accumulated case law is that this particular trust was going to have its central management and control in Canada. Assuming that's the result that you want. If you're hoping for a different result, then you might not be relying on it in the same way. It'd still be very useful to know about this being the likely outcome if it were to be challenged. But it's a way of informing you and how much risk you're going to be taking on for a client, just to make sure that you're proceeding well aware of what the risks and potential liabilities might be. So some of you might have realized here that there's this Find More Cases button. So I can click on that. And this is going to take me out to the case finder for central management and control. And so it's going to show me the cases that are most similar to the particular case that we looked at here. So here's one, Crossley Carpets. And what I can do is, looks like there are 3 of these cases that are very similar. It looks like Crossley Carpets is coming up twice here. So what I could do is look at this case list. So it's coming up twice because there are multiple rulings. So there are different taxpayers involved here. So this is naturally picking up the fact situation of different taxpayers. So what I can do is download this if I'd like, or I can share it, and I can email it to someone else. I'm just going to email it to myself, ben@bluejaylegal.com. Ben, here are the cases we need to read for the appeal. Thanks. I click that. It's going to send me the email. So this is really useful if you're working with others on a particular case or a particular situation. You just want to make sure that you're sharing the most relevant cases with your coworkers. You can scroll down. You can find more cases. You can mix and match here. And so you could, if you wanted to, you could find cases just by year. You could go, okay, I want to find all the cases between 1990 and 2000. Let's see, 1980 and 2000. So we got all the cases between 1980 and 2000. You can clear all those and check it out. You can see how similar they are, what's different about them, and so on. Okay, so I'm going to clear that. I'm going to go back in here to Tax Foresight. I'm going to head back to the home screen here. I think you get a sense of how it works and how you can change different answers and how it influences the results. I'm just going to spend a few minutes going through all the different stuff here. So we've got worker classification. So this is, again, employee versus independent contractors. We've got gross negligence. So is a taxpayer going to be on the hook for gross negligence penalties subject to the provisions of subsection 163(2) of the Act on the basis that they were not sufficiently diligent in complying with their tax obligations? Can the CRA open up earlier taxation years beyond the normal assessment period to reassess a taxpayer on the basis of carelessness? And so this classifier is trained on all the case law in which that's an issue. We have a classifier for exempt financial services for HST purposes, a very popular question. So can you actually claim that a certain supply is exempt pursuant to subsection 123(1)? A bunch of income versus capital classifiers, so tangible expenditures. So if you're spending money on land or buildings or machinery, can you deduct those currently, or are they capital expenditures? Intangible expenditures, the same thing, but for things that are intangible. So if you're spending money on marketing or on customer lists or on intellectual property, can you deduct that currently, or do you have to treat it as a depreciable item? Real estate transactions, very, very heavily used classifier here in Tax Foresight. Are the gains or losses on the sale of real estate appropriately treated as income or capital in nature? And I think there's been a bit of a lot of activity relating to reassessments based on real estate characterization, especially with the run-up in real estate prices in some parts of the country. Securities trading, buying and selling stocks, bonds, other securities, should that be treated as on income account, as business income, adventures or concerns in the nature of trade, or as capital gains or losses? Tons of cases on that. We've trained up a classifier there. Windfalls. So if you are engaged in playing poker as a full-time activity, is that actually income to you, or is that actually, hobby gains that don't have to be reported as income? We've trained a classifier on that distinction. Business versus property for rental properties. So is it investment income, or is it a business activity that's given rise to that rental income? A very important consideration in a lot of cases. Taxable benefits, talked a little bit about taxable benefits, the primary beneficiary. This is very interesting. So this will tell you whether the taxpayer is the primary beneficiary, so where the taxpayer is an employee, or whether the employer, the payer of, or the provider of a certain benefit is actually the primary beneficiary of that benefit for the purposes of paragraph 61A of the Act. Shareholder benefits, same thing, but for in the context of shareholder benefits under Section 15 of the Act. Now we've got a number of things on deduction. So are home offices deductible or not? And this applies all the case law, both to those who may be independent contractors or those who may also be employees with home offices. Capital cost allowance is really cool. So this steps you through what amounts to kind of 20 questions to narrow down the class of depreciable property that a certain asset would fall into. So go into the navigator, boom, 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 it starts asking you questions, and it will take you out through to the other side and suggest the class of depreciable property that a certain asset would fall into under the regulations. So very, very interesting use case for machine learning there. CCPC status basically steps you through the classification of a company as a Canadian-controlled private corporation. Interest deductibility, this comes up all the time. Can I deduct this interest expense or not? And the Act has tons of rules that interact with each other in complicated ways. So the interest deductibility navigator can help you work through those rules and will let you know if deductible or not. Residency. So the residency classifier is very interesting. It works you through whether there are any deeming rules that would deem you to be resident in Canada or not. It works you through whether on common law principles, similar to the ones we were talking about in today's context for trusts and corporations, whether that individual for common law purposes would be resident in Canada. And that also applies the treaty tiebreaker rules to figure out in the event that you're resident in multiple jurisdictions at once, whether you're resident also in that other, or whether you'd be resident in Canada or that other jurisdiction based on the treaty tiebreaker language. So very, very useful for individuals for residency purposes. Carrying on business, really useful for figuring out whether you actually meet that threshold test, minimal threshold test for carrying on business in Canada. Relatedly, the permanent establishment classifier helps you figure out if you meet that higher threshold of activity to be considered to be carrying on business or have a permanent establishment in Canada for the purposes of tax liability under the Act. And of course, central management and control, which we talked about today. Director's liability, GAR, got some election navigators around Section 85 rollover, so very, very useful stuff there. And finally, I'll just close off here with a plug for the single versus multiple supply classifier. So oftentimes there are questions about whether something's a single compounded supply for GST, HST purposes, or whether some provision is ultimately separate provisions of different things that should be taxed at different rates. So obviously the taxpayer has an incentive to bundle multiple things together to claim that they're a single supply of the lowest rated or maybe zero rated good. On the other hand, the minister has on average, the opposing interest, which is to break apart things and claim that they're not a single supply at a lower rate. So these issues come up all the time in tax. So thanks very much. I believe we're out of time now. Thanks very much for your attention. Today, it's been a pleasure hosting you in this webinar. What I will do is suggest that if you would like a personal and free walkthrough of tax foresight with one of our lawyers, please send a text to us at 416-564-4696, or just email me, ben@bluejaylegal.com, and we'll put you in touch with one of our lawyers. And for those of you who are tuning in to get CPD credit, love your attention, love you coming back. Tell a friend, bring them to the next one. These webinars are completely free, and in future we'll be talking about new classifiers and different things that are likely to be of interest in your practice. Thanks very much, and happy end of July. Take care.